What is dividend capture with options? Have you ever wondered how traders can profit from dividends without holding onto stocks for long periods? Today, we will explore the concept of dividend capture with options, a strategy that can help you take advantage of dividend payments while managing risk. Dividend capture with options is a trading strategy that focuses on profiting from dividend payments using options contracts. The main idea is to gain exposure to a stock just before its ex-dividend date. This date is crucial because it determines who is eligible to receive the dividend. In traditional dividend capture, a trader buys the stock before the ex-dividend date to qualify for the dividend. After this date, the stock price usually drops by about the amount of the dividend. Traders aim to collect the dividend while minimizing losses from this price adjustment. Now, let's see how options come into play. Options provide flexibility and risk management. Instead of simply buying and holding the stock, traders can use various option strategies to capture dividends and protect against price declines. One common approach is buying the stock and protective puts, also known as married puts. Here, the trader buys the dividend-paying stock and simultaneously purchases put options. These puts are usually in the money, meaning they have intrinsic value. This strategy helps limit downside risk if the stock price drops after the ex-dividend date. Another popular method is the covered call strategy. In this case, the trader owns the stock and sells call options against it. This generates premium income, which can help offset any price decline after the dividend is paid. Covered calls are often used because the option premium typically reflects the upcoming dividend. There is also a strategy called dividend arbitrage using in-the-money puts. This involves buying the stock before the ex-dividend date and purchasing in-the-money put options at the same time. These puts allow the trader to sell the stock at a predetermined price, protecting against losses if the stock price falls after the dividend is paid. Timing is essential in this strategy. Traders must buy the stock before the ex-dividend date to qualify for the dividend. Options used for hedging or income generation are usually selected with expiration dates shortly after the ex-dividend date, often 2 to 6 weeks out. When selecting options, traders often prefer at-the-money or in-the-money options. These options have higher premiums, which often include the expected dividend value. Out-of-the-money options may be used if a trader wants to hold the position longer or reduce upfront costs. It is important to consider the relationship between the option premium and the dividend. The premium often approximates the dividend amount since option buyers want to capture the dividend. This dynamic can affect option pricing and the risk of assignment. Using puts as protection helps manage the risk of stock price declines after the dividend payout. While covered calls can generate income, they may limit potential upside. In summary, dividend capture with options combines stock ownership around the ex-dividend date with option contracts to manage risk and enhance returns. By buying the stock to qualify for the dividend and using puts or calls, traders can protect against price drops or generate additional income. This strategy requires careful timing and selection of appropriate option, strikes and expirations to align premiums with dividend expectations.